think the sales price is the only number that matters in a Hawaii real estate deal. Cute! If you are buying or selling in paradise, there is a hidden troll under the bridge called the conveyance tax. On a luxury property, this single tax can cost as much as a brand new car. But who actually writes the check? Is it the buyer, the seller, or do you split it like a bad first date? I'm Jason Wong, a licensed real estate broker in Hawaii, and today I'm breaking down exactly who pays, how the math works, and the one little checkbox that can save the seller thousands of dollars. Let's dive in. First off, what is the conveyance tax? Think of it as the cover charge to get into the club of Hawaii homeownership. It is a state tax imposed on the transfer of real estate. Important note, this is not property tax, which you pay every year. This is a one-time transaction fee paid at closing. Hawaii uses this money to fund things like land conservation and affordable housing. So when you see that bill, just tell yourself you're saving the turtles. Now the million-dollar question, who pays it? In Hawaii, tradition dictates that the seller pays the conveyance tax. I know sellers, I can hear you groaning from here. You're already handing over the keys. Why do you have to pay the tax too? Well, that's just the standard practice here. However, everything in real estate is negotiable, my friend. In a really hot seller's market, I have seen sellers tell buyers, you want this view, you pay the transfer tax. But generally speaking, sellers, prepare your bank account. This one is usually on you. Here's where it gets spicy and where you need to pay attention. Hawaii uses a progressive scale. That means the more expensive the house, the higher the percentage you pay. But there is a twist. There are two different tax rates. Tier 1 is for buyers who are owner-occupants, people who are actually going to live in the house and file a home exemption. Tier 2 is for investors or non-residents, people buying a vacation home or an investment property. Here is the kicker. The Tier 2 tax rate is higher. So, sellers, listen closely. Your tax bill depends on what the buyer is going to do with the house. If your buyer is a nice local family moving in, you pay less tax. If your buyer is a wealthy foreign investor, you pay more tax. Yes, the seller pays a penalty because the buyer is rich. Welcome to Hawaii real estate. Let's do some quick math so you can see the difference. Let's say you are selling a home for $2 million. Scenario A, you sell to a buyer who will live there. The tax rate is lower. You pay roughly $10,000 in conveyance tax. Scenario B, you sell to an investor who won't live there. The tax rate jumps up. Now you are paying roughly $12,000 to $14,000 in conveyance tax. And if you get into the ultra luxury market, say $6 million and up, the difference can be tens of thousands of dollars. So how do we use this to win? If you are a seller, when you are reviewing multiple offers, look closely at that owner-occupant box. If the offers are identical, the owner-occupant actually nets you more money because your taxes will be lower. If you are a buyer, especially if you're an investor, be aware that your status makes the seller's closing costs higher. You might need to offer a slightly higher price to keep the seller happy. Look, nobody likes paying taxes, but in Hawaii, it's the price of admission for owning a piece of paradise. Now, conveyance tax is just one line item on the closing statement. Thank you for watching. Until next time, my friend.